in March 2020, I remember at least Ford halted or cut or reduced their dividend. So if you didn't buy at that like 30% lower mark before, which was probably 10 years ago, you're at a loss with Ford. I know you're a huge fan of the buybacks, and I've been listening to you a lot talk about them. You're very, very strong on that. You bought into it. So you tell me, what's the difference? And is one really much superior to the other? Is the dividend a lie?
I would say every form of repayment of cash flows from the company to the investor is good to have. So it's good to have a return in the cash flow, but is different because with dividends you are happy because you see the dividend in your bank account. With buybacks is more implicit and you can see the reward of the buybacks only if you are a long-term investor. With dividends it's like, okay, you have the little candy now, you pay dividends on it. So on the short term dividends are better because you have cash in the account, you're happy, but that comes with a cost. Because, as you said, there are risks of perceived safety, and there is nothing riskier than perceived safety when something is not safe. What you said before of Ford is an example that should be very taken into account. When you buy a dividend stock, you must buy it because you like the business, and you need to ensure yourself that even in difficult times, the company must be able to keep paying the dividend. Especially if it has the label of a dividend aristocrat, you need to do due diligence in assessing, okay, how much safe is the dividend? Because right now, many companies, just to keep delivering the promise of paying a dividend, because it's a commitment, you have to think that once a company starts paying the dividend, increasing the dividend, wants to become a dividend aristocrat, it's very hard to say, now I don't pay the dividend any longer. Because a lot of people, pension funds, investors, now start putting money on your company just for the dividends. If you break the promise, then you break the trust, and you will not be labeled any longer as a dividend stock. And for instance, Intel has had this problem that right now Intel is in a weak situation, but it needs to keep paying the dividend just to stay there in the indexes. So since the company is not growing much right now, it is increasing the dividend just a little bit. But the problem is that you are forced to pay the dividend just to stay in the indexes. And even in moments where maybe you would like not to do it. It's very different from the buyback, where the company explicitly has excess cash. It realizes, okay, now I can opportunistically invest money in something that I know that works well, and I can buy it for cheap. So by buybacking the shares, the effect is the same. Is the cash that goes from the company to the investors. With dividends, investors are happy because they see directly the cash, but they pay the taxes as they receive it. Buybacks is a form of dividend that become real in terms of decreased number of shares. By decreasing the number of shares, the multiples decrease because every share gives proportionally more earnings. Therefore, someone who's invested for a long time benefits more, not only because they are more tax efficient, but also because the company can opportunistically buy back more when the prices are stupid. Let's say Apple right now drops minus 50%. By spending exactly the same amount of dollars, it gives a benefit to the shareholders of 2 times. While with dividend, the amount you give is exactly the same. So the dividend is good because is independent by the market movements. But if the market drops, a dividend is a much smarter way to reward the shareholders. And it doesn't force you implicitly to do it. It's more the company saying, okay, I can deploy opportunistically cash in something that I know well, that offers a good return. It is very stupid, on the other way, doing a buyback if the company is overpriced, clearly.
This is what I see for now. A dividend is a little more dangerous because once you give it, I don't think it's possible to reduce it or remove it. Then you look bad.
Exactly. It's like a promise, like a commitment, and it's very hard to break. So rather than breaking the commitment, you'd rather keep leveraging your balance sheet. Maybe just like Coca-Cola is doing, delivering more to shareholders than it is producing in terms of operations.
Okay, beautiful. So, I'm glad you mentioned Coca-Cola. Let me jump in here. Coca-Cola, from what I remember seeing when we were looking together the other day, they give a dividend, yes, but they have debt. Am I mistaken in assuming or believing that Coca-Cola is using debt to pay out the dividend?
Well, to be clear, Coca-Cola is not a financial distressed company. Now I don't remember the exact ratios.
Yeah.
But the idea is that there is nothing wrong with debt per se, especially if you can raise it at a low yield.
Yes, exactly.
But you need to be extremely careful when the company has debt. And you should not underestimate the impact of debt, because debt is great when things go well, because by having a fixed amount of interest you have to pay, it generates a leverage effect on the EPS. So it helps the EPS growing more than the situation of not having debt. But debt can be very dangerous when things go wrong. Therefore, in the case of Coca-Cola, it's Coca-Cola, so we can say it's safe, even if it leverages the balance sheet. I mean, you can be the dividend aristocrats, but you need to grow, especially when there is inflation, because the debt sooner or later must be refinanced. So when you have debt and it reaches maturity, or you pay the debt in cash, or you refinance your debt. But when the interest rates are high, taking that additional debt is costly. And you can't take debt that costs more and more while your operations don't grow. Because that is basically the situation of Coca-Cola. The business itself is great, but is there, flat. While the amount of debt gradually increases, because if they're paying out in dividends more than their earnings, they're going towards a situation that could be dangerous. Right now, maybe it is not, but maybe in the future could be. It's a very, very different story from that of Apple and AMD. These companies produce a ton of cash and they leverage some debt. How come? When you have a lot of cash in the bank account, you can raise the debt at a very, very low yield. If I remember correctly, Apple right now can issue debt at a lower yield than the US government. That's crazy. Because it has so much cash there in the sitting bank that makes Apple extremely safe. When you can raise debt at a very low yield and then your stock is trashed, then it's the perfect situation where you can use that cash you have there in the sideline. You paid nothing to having it, and reward shareholders.
This is another difference that I believe I'm understanding. If the stock price goes down, like we see in these dips and crashes, a company is buying back, well, they're buying back their own stock at a lower price, which is actually advantageous, which increases the intrinsic value. But in the case if I bought Ford or Coca-Cola for a dividend and the stock price goes down 30%, well, there's not really an intrinsic gain anywhere. I'm at a loss in my initial investment, and then I risk the danger of them cutting or halting the dividend completely.
Mm-hmm. Exactly that.
So let's clarify one more thing. The dividend, dividends, they're perceived that once you give them, listen, they should stay, and not only should they stay, they should increase. But correct me where I'm wrong on this dividend, on the buyback. I'm assuming they issue a buyback program and they say, okay, for the next 2 years, 3 years, we're going to be buying back 500,000 or 1 million stocks. Is that correct? So it's more of a temporary plan. So if a company has extra cash for the next 3 years that they don't need to use for acquisitions, they're going to say, okay, let's do a stock buyback program for the next 2-3 years.
Mm-hmm.
Is that correct? Wow. So because there it's a short-term promise, at least, that could be respected, and then after 3 years they regroup. But a dividend, it's like you're getting married.
Exactly that. Is a much stronger commitment because a lot of people rely on that flow of dividends. The problem is that the buyback gives you the flexibility in addition to the tax advantage and the opportunity to exploit market weaknesses. The dividend is more, I commit to pay it so that my shareholders are happy and my investment base stays quiet. That generates more stability in the stock price. But as we said before, you need to be extremely careful because sometimes some dividend stocks can be in a very weak position where they're forced to pay the dividends, they don't want to, and they don't grow. So you have the perceived safety, but in reality, you can double hit. Because as you said, let's say something bad happens, the stock can say okay, paying the dividend right now is extremely risky. You're double hit, no dividend and a company that is trash. While with a buyback, the company can say, okay, something bad happens to our operations, it's better to deploy this cash for our operations because we must be safe first. And then the additional cash can be deployed for buybacks.
You think dividends are safer, but in reality, they could be riskier.
Think this way. Buffett bought a huge amount of Apple many years ago. And by doing nothing, just with Apple, by backing the shares, its percentage increased to 12%, something like by 2% or 3%, just by doing nothing, but waiting the company to buy back. So what happens is that by doing nothing, Buffett is rewarded and doesn't pay the taxes on it until it sells the company. And in the reality, with these companies buybacking shares, you can create your own dividend because let's say Apple AMD pay the dividend in repurchasing the shares, the multiple decreases because the EPS increases. And then if the multiple stays flat, then you can say, okay, I sell 5% of the shares. But you're not forced to. So the buyback has a lot of advantages, is generally not fully understood, and that is actually why I like it. Of course, there is the risk that when a crash happens, these stocks are still hammered. For instance, AMD has started by backing shares at 130. Now the stock is around 80. But what happened? The stock crashed, and every additional day the stock stays this low. Implicitly, the value of the shares increases not only because the company grows, but also because the cash flows from the bank account of the company into the higher EPS. So right now, AMD is buybacking shares at a PE of less than 20, with an amount that compared with the market cap is around 5%. So AMD, it has a PE of 15-20, around that, growing more than 50% by backing 5% of the shares at the current price. So it's basically saying it has a dividend yield of 5%, which is higher than Coca-Cola. But since it is not visible immediately as a dividend, people don't fully understand it and they leave money on the table there. I think the best would be to buy companies that are great companies a priori and that are not in that phase where they don't grow any longer. Because for instance, if you bought Apple 5 years ago and you kept Apple, you would have benefited from the buybacks, but also from the dividend, which was okay, let's say 1-2%. But since Apple is growing, that dividend increases much more than a company that is flat and doesn't grow in terms of operations. Because as we said before, if the operations don't grow, the dividend increases, you have to fund that dividend with some leverage. And that starts becoming a risky position. So as a reference, I prefer companies that have a very low payout ratio in terms of dividend. The payout ratio is the percentage of earnings that are distributed in dividends, but have the opportunity to buy back shares, especially at a very low price, with debt issued at a very low yield, because they are super stable.
From what I learned from you, the buyback is super powerful and extremely underrated. So we might have to do a few episodes of this because I think it's the weapon that nobody knows they have. So we'll continue. I thank you for your time and we'll talk soon, Bello.
Thank you for the Spuntino.
Thank you. Ciao, ciao.